India's paint sector demonstrated strong demand resilience in the last few years owing to government's affordable housing push, shorter repainting cycles and upgrading by existing customers. Now, historically, investors have flocked to high-quality companies such as Asian Paints and Berger Paints in an uncertain market environment as they have the strongest capability to weather a crisis. However, the recent news flow as well as price action suggests that the trend seems to be changing as the paint stocks have started to falter in a weak market environment. Why is that? Let's find out. Over the past 3 years, the sector has seen a major influx of new entrants. Grasim's entry created quite a buzz. It's going full throttle on its paints business foray and plans to invest 10,000 crores by FY25. In 2019, JSW Group forayed into the paint segment, starting with coil coatings, offering a complete range of decorative paints. It has already raised $100 million from PE investors as well. In addition to that, JSW Steel, which is the parent company, has also committed an investment of 750 crores into the paints business. The paint industry is set to add another color to its palette as JK Cement recently announced its foray into the paints business with an investment of 600 crores. Meanwhile, Astral has also acquired 51% stake in Gem Paints for 194 crores. Remember, Grasim, JK Cement, JSW and even Astral are all heavyweights in their respective sectors and can leverage their existing dealer network to make inroads into the paint market. While the situation is likely to have greater impact on smaller fringe players, it may also dent the growth trajectory and market share of the leaders. Existing players, on the other hand, may strategize a price-cutting approach to protect their turf, as new entrants would be vying for the same or even better investments, product portfolio and reach, intensifying the competition. The last time this happened was in the auto industry, if you remember, wherein a similar situation was faced by Maruti Suzuki, which had been maintaining a market share of about 50% in the Indian passenger vehicle space for a very long time, quite similar to that of Asian Paints. Bulldozed by competition, India's largest car maker has witnessed a massive drop in its market share to 42 to 43% in the last couple of years. Crude oil continues to trade at elevated levels due to the ongoing geopolitical concerns. Steep jump in the price of crude derivatives, which account for 50% of raw materials, as well as critical raw materials like titanium dioxide and monomers, have put pressure on the paint industry margins. While paint companies have undertaken successive price hikes to mitigate inflationary pressures, it remains to be seen how consumer spending responds to these steep price changes over the next 2-3 quarters as demand has slackened off late due to uncertain global scenario. Paint penetration in India is relatively low, but the intense competition from new players could make the fight for market share tougher for all the players. While inflation will keep margin profile under check in the near term, the rising competitive intensity is expected to put pressure on earnings growth in the medium term. Asian Paints and Berger Paints have delivered superior earnings growth through business cycles. As a result, both the stocks have rewarded investors handsomely in the past decade, partly aided by a valuation re-rating. Asian Paints trades at 60 times and Berger at 75 times of FY23 earnings. The valuations are at a significant premium to the likes of HUL, Dabur and appear to have already discounted the long-term growth trajectory. Taking into account the astounding valuations and the prevailing market scenario, we believe that the entire sector is staring at a valuation derating cycle, which may continue for a prolonged period of time, perhaps 3 to 5 years or maybe even longer. For instance, Walmart stock went through a 10+ year derating cycle, even though the company exhibited steady earnings growth. Now, while the paint sector may continue to grow at a steady pace, investors should definitely look to cash out of these stocks as best of the returns might be behind us.